I often get a question about why I use the RSI strategy in many of my videos. So I thought I'd dedicate a video to answer this question. So in this video, I will show you what is the RSI, how to construct an RSI strategy on the S&P 500, how to construct many versions of this strategy, combine them all in a portfolio, and show you the performance of this portfolio with some filters. So first of all, what is the RSI? RSI is the Relative Strength Index. And basically, it is a momentum indicator that measures the changes in price and plot it as an oscillator. Now, any oscillator can be used effectively in a mean reversion strategy. Now, what is mean reversion? In my hand here, I have an elastic band. So this is the normal state of the band. And if I exert pressure on it, it will stretch. But once I release that pressure, it comes back to its normal state. And the instrument price behaves the same way. So normally it sits in a band. And when you apply a buying pressure or selling pressure with speed, the price will move away from that zone quickly. And then it tends to get back to that zone. So that's basically mean reversion on price. Okay, now we know why I do the RSI in a mean reversion strategy. The question is, why do I do it most often on the S&P 500? And the answer to that is really easy. I want to make money. So I'm not concerned with how sexy the strategy is or what type of instrument or what time frame. I only want to make money in the easiest way possible. And the S&P 500 is really suited for long mean reversion. Now, this is not a fluke. In fact, you can test this, and I teach my students how to do that test. So basically, you will know this instrument will work really well with long and mean reversion. Each market has their own characteristics, and the S&P 500 changed that characteristics back in the 90s, and it switched from a trend following to a mean reversion instrument. Now, that switch doesn't happen overnight. Usually it takes, months, sometimes years, to slowly switch to a different characteristics. And usually that is when more traders trade the same instrument. So think of the S&P 500. We have futures, we have options, we have ETFs, and inside there are like 500 stocks that also have futures and options, and there are all these arbitrages that are done on these. So that create a lot of noise in the market short term, and that characteristics tends to come out as mean reversion. Okay, so talk is cheap, as they say, and it's very easy to come up with a conclusion after the fact. But as algo traders, we of course don't care about that. We only care about testing and validating our strategies with statistical numbers. So before we do any testing, let me show you the behavior of the RSI on the S&P 500. At the top here, I have the S&P 500, and below it, I have 4 RSI indicators. So this is RSI period 2, which I usually refer to it as RSI 2. And then this is 4 periods, 8 periods, and the 14 periods at the bottom, which is the default in every platform on the planet. Now, the levels I put here is 25 and 75. Mean reversion, meaning we will go long when it's below a level and we will exit when it is above a level. Because with mean reversion, you're going long on a pullback and you're exiting when it is overbought. So clearly you can see from the chart that the RSI 2, which is RSI period 2, shows many signals in the same period of time. And then the RSI 4, less signals. RSI 8, almost one signal here. And RSI 14, actually no signals at all to go long. There is a signal here to short, but we are just going long. So from this chart, we know that we will get more trades with shorter period and less trades with longer period. So that is observation 1. Observation 2 is we get more extreme measurements with shorter period and less extreme with longer period. So for example, look at this RSI 2 here, the value is 2.5. Here is the same bar, the value is 19. And on RSI 8, the value is 41. On RSI 14, the value is 53. Since November of last year till April, the RSI 14 didn't go below 50. So just from looking at the charts, we can expect the behavior that the RSI 2 will have more signals, more extreme measurements, and the longer period you go, less extreme measurements and less signals. And we can deduct that the RSI 14 or RSI 10 and above, it's more suited as a filter rather than a signal. But then shorter time frame, you can use the RSI now to enter and exit a trade. So that means it's a signal, not a filter. So here I have the ES Mini S&P 500 futures, and I have the RSI 2, which is the RSI period 2 strategy applied, which is when the RSI period 2 go below 25, we buy. And then when the RSI period 2 go above 75, we sell. The strategy behaves really well on the S&P 500. On average, we get about $520 with almost 74% win rate. The strategy made $183,000 on a single contract with 4-to-1 return to drawdown ratio. This is the equity curve, and we suffer a little bit here in COVID and in 2018. And this is the annual period analysis. So we lost only in 2018 since 2006, and every other year is profitable. Obviously, the strategy is doing very well. It's been doing very well for the past 5 years with its all variations. So I have many variations of the strategy, even on the channel. And in fact, just last week, I had a really good trade where a single contract produced about $6,000 in profit. Now, this is not an optimized strategy. So many people think that I optimize the RSI2 to produce this. In fact, the RSI2, just like I showed you, produce really good signals on the S&P 500 because of the characteristics of the S&P 500. But the RSI2 produce more signals, and that's why I use it more often. But now I will show you that in fact, the spectrum of the RSI produce good results. So I will optimize the RSI2 from 2 to 14, which is the default in every platform. And then we will optimize the level to buy. So if it goes below 5 all the way to 45 in a step of 5. And we will exit when it's 55 all the way to 95 step of 5. Now, why I'm doing this? Because like I showed you, the RSI 14 will not have a chance to go below 5 or 25. So we need to give it more leeway. Anyway, we will see all the combinations. We have about 1,000 combinations. So because of these combinations, sometimes we will not have trades. So I can show you here, we have 0. So for example, period 6 is 0. It's actually not 0. This is one trade, but it's not closed. So it entered once below 5 and then didn't reach 95 at all. So that's why the trade stays open. And then this is 7 below 5, no trades at all. And then 7 below 10, that's also a trade that is not closed. So that's why it's showing 0. And we go further down. So we have, you see, we have many that are 0 trades. So first of all, we need to filter the number of trades. Pick anything above 70. Remember, we have 1,054 strategy. So if we add this filter, we end up with 288. So that's not bad. That's about 30% of strategies produce more than 70 trades. And let's look now at the first observation. So sort by net profit. The lowest is 33. The lowest. So all strategies that produce more than 70 trades, all of them are profitable. And the profits from 33 all the way to 238,000. Now, this is not including slippage and commission. So let's look at the average trade. So the minimum average trade is 255. So of course, that's more than cover our slippage and commission both in and out. So definitely all these strategies are viable strategies. And the best one is about $2,000 on average. So now let's see what parameters produce these results. If we go by maximum profit, we see that the RSI2 is on top and then followed by 3, sometimes 4 here, 2 and 3. Mostly is 2 and then next one is 3. And then if I want to look the lowest drawdown, which is 19,000. So this is RSI 3, 3 and then 2 and then 3 and so on. Then if I want to go to return to drawdown ratio, again, I have 2, 3, 2, and 3 on the top. If I want to go by average trade, I have 4, 6, 4, 9, 4, 7. And then if I want to go number of trades, so the lowest number of trades is 4, 7. Remember, low number means I pay less commission than high number. And then if I want to go by win percent, this is 81%. And the RSI period is 8, 3, 4, 7, 9. And again, these are longer periods. So far, longer periods produce better average trade and better win percent. And if I want to go by profit factor, 6, 3, 10, 7. Again, the longer periods are better. And then if I want to go by maximum consecutive winners, again, longer periods are better. Although here we see number 2 at number 11. And the lowest maximum consecutive losers is 2 and 3. First of all, 30% of my optimization producing profitable optimizations. This is not about finding a strategy, then enhancing it with filters, stop loss, profit target. No, it's already profitable with good average trade. So that's really a huge testament to the RSI. But remember, it is huge because we matched it to the right instrument and right direction. But as a proof of my robustness, that the RSI, in fact, all periods produce really, really good results. Not only that, I can get a different equity curve from choosing a different RSI period and entry exit level. That will help me when I construct a portfolio. So here I have a portfolio of 10 strategies. All the strategies are applied to the S&P 500 since 2006 all the way to May 2024. And I applied different strategies. So this is bar 2. This is the RSI period 2. We buy when it's below 30. We exit when it is above 85. So this is 3, 10, 60, 2, 30, 65, 4, 35, 85, and so on and so forth. These are only 10 strategies. I basically picked the top, a strategy that is in the top 10 for every criteria. This is what we get. It's about 1.5 million, 3.2 return to drawdown ratio. Now, first, I want to draw your attention to the correlation matrix here. And even though we are using the same instrument, the same strategy, which is the RSI, I'm only changing different periods and levels. And look at these correlations. I know we have some of them like 93 correlated, but a lot of them are less correlated. So for example, look at this one, 0.47, 0.51. And this is the equity curve, and this is 2020 COVID dip. So this is a huge dip, is about $400,000. But of course, at that time, we are about 900,000. But still, so this is a big drop. Now, you can pick and choose the strategies from the previous optimization to lower this drawdown. Either you need a good software to do it or a lot of trial and error to do it. But I will skip that part and just try to enhance it with a filter. Remember, our strategies here, they don't have stop loss, they don't have profit target, and they don't have any filter. Now, instead of optimizing the best filter for each strategy, I'm just going to use a single filter for all strategies. Not because I want to do a robust filter. It's just because I don't have the time to optimize all these strategies with better filter. So this is amazing result from a single strategy on a single instrument. This is exactly the same style of strategy. I'm not even changing the style. Same indicator, yet you get a lot of diversification just from changing the look back period and the entry exit level. Okay, so now I introduce the volatility filter, which is basically we will not take a trade unless the volatility is going down. So our total profits go down from 1.5 to 1.2 almost. But more importantly, we increase our return to drawdown to 7. So that is a tremendous achievement. Single filter, it's the same filter on all strategies, produce this amazing result. And we can see how different our equity curve is. Remember the 2020 dip, which is about $400,000, that is completely erased from our portfolio. This is our annual return since 2010. We don't have any losing year. Average trade, about $1,100, 77 win percent. So overall, amazing result. And also the correlation is better. Of course, you cannot see this because MultiCharts doesn't allow us to do this. So I already saved it. So this is the RSI Classic portfolio with no filter. And this is the RSI Classic with the volatility filter. Taking the same strategy, but only when the volatility is going down. And the same filter for all 10 strategies. First of all here, I mean, probably you cannot see it from the colors, but we have lower correlations. So look at this. The average correlation here was 0.7. Here it's 0.5. The lowest here was 0.46. And here the lowest is 0.18. So not only we increased return to drawdown, we increased our win rate, we reduced the drawdown, we increased our average trade. We also reduced our correlation with the same filter. It's only a single filter. This is the difference between the two correlations. So only one strategy where it got a little bit worse. So strategy number 1 and strategy number 5 lost a little bit, increased its correlation a little bit. And strategy number 1 and strategy number 9 increased the correlation. All other correlations went down. All of them. The takeaway is the RSI is an extremely robust strategy when it is matched with the right instrument. You cannot go wrong with the RSI any period, any level on the S&P 500. Plus, you can spend more time and add different filters to get even more diversification from the same strategy, same instrument. If you like this video, then you will love this next one.